Hello, this is Rich Vessel, founder of Advanced Projections, with our April 2024 AP report. Just a note, our reports will now be issued between the 20th and 25th of each month, as we must await the results of FOMC meetings, as well as leading economic indicators and margin borrowing data published in the latter half of the month. We may resume publishing earlier in the month when interest rates have leveled out at the end of this Fed cycle, perhaps somewhere in 2026. So let's start out the report with an excerpt from material published by Bloomberg on April 15th as one of their top stories for the day. Hopefully, this should not at this point be a surprise to our subscribers. Bloomberg says, the combination of strong U.S. growth and sticky inflation is raising the odds that the Federal Reserve may actually hike rates again, bringing borrowing costs as high as 6.5% next year, according to UBS strategists. While the Swiss bank's base case is for 2 rate cuts this year, it now sees a growing possibility that inflation fails to decline to the Fed's target, spurring more hikes after a period of wait and see. Markets have already scaled back bets on policy easing, as recent U.S. data has shown continuing strength in the world's biggest economy. And that's the end of the Bloomberg remark. Now, for the actual bullets for this month, employment figures for March came in with another strong new jobs figure, up 303,000, with the unemployment level moving down slightly to 3.8%. We continue to expect unemployment to gradually move upwards to over 4%. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through March was announced on April 10th, and the actual reported value was 3.5%, which was again 0.1% above expectations. Now, that was also 0.1% above the February reading of 3.4%. Additionally, the core CPI that leaves out volatile food and energy prices was still 3.8%, and sticky price inflation, less food and energy, continued high in March at 4.6%, which was still about 2 times higher than what the Fed wants to see. As oil prices have moved back up over the past few weeks and now well into the mid-80s per barrel, motor fuel prices will continue adding a bit to the CPI headline inflation numbers in the months ahead. The Federal Reserve FOMC maintained their paused rate hike program in late March, with their last increase of Fed funds back on July 26th of 2023. So this key interest rate remains at 5.25% to 5.5%. However, their March dot plot once again changed from just 3 months ago, signaling more higher for longer. We discussed this in our last 2 reports and will repeat key points below in our details. The continuing solid employment picture is also confirming a higher for longer rate scenario. We now consider the probability of one more surprise increase, as core inflation and the sticky inflation numbers are still double where the Fed wants to see them. This final or not so final increase may come anytime between now and the end of the second quarter of 2024, but the probability of it actually happening has picked up as core and sticky inflation numbers again begin trending upward. The S&P 500 index pushed deeper into bubble territory once again, closing March at 5254, up under 160 points for the month. A significant equity run-up in late March paused in the first half of April and continued to fall slowly right up through the release of the latest inflation numbers on April 10th. Now, we had expected some irrational exuberance for a few weeks after the Fed's fourth quarter dot plot came out, but it extended throughout the entire first quarter of 2024. even while our measures of market overconfidence again returned to the July of 2023 extremes. Equity indices were all setting new records. There is clearly too much cash and enthusiasm still available to feed into this equity bubble. Most popular financial press outlets are saying that, markets are behaving typically and not in a bubble. We claim this is utter nonsense. Our indicator system keeps our recession risk level at about 80% due to leveling off of previously declining leading economic indicators, less hawkish Federal Reserve monetary policy signals, and ongoing red AP indicators. One of our 6 indicators shows yellow and the other 5 are red. We have temporarily modified the balance between the OECD and Conference Board leading indicators, which then turned ours red for the past 3 months, including March. Here are the current underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this March's CPI announcement were for 3.4% year-over-year inflation, and it came in at 3.5%. Consumers are still spending massively, even as consumer confidence readings continue to drop, and they have accumulated record amounts of credit card debt, having exceeded $1 trillion by the end of last year, and it is now closing in rapidly on $1.2 trillion. Overall, household debt now exceeds $17.5 trillion. The Bureau of Labor Statistics reports unemployment decreased slightly to 3.8%, with another surprising new jobs figure gain for March, where they added 303,000 new jobs. We include in our written report the usual labor statistics table, which shows all the household data, employment numbers, and employment rates. Now, this currently solid employment situation continues to allow the Fed to be as free and as slow as they deem necessary in their scripts for interest rate policies and in their plans for unwinding their balance sheet to slowly decrease the money supply. They previously implied that their rate increases have come to an end, but with 3 and probably 4 new months of increasing inflation, it is a distinct possibility that they may have to raise rates 1 or 2 more times. Also, there's only been a modest reduction in the Fed's balance sheet from about $8.97 trillion to $7.44 trillion, and we believe much more needs to be done in that regard, to the tune of about another trillion or so, to a final target level of about $6.5 trillion. However, the FOMC has just stated that they want to look at ending their balance sheet unwinding fairly soon, and we believe this is at least a bit premature. On the energy front, as you know, OPEC and Russia had previously agreed to voluntary production cuts a year ago, and then again in August 23, and then again in March of this year to support prices for their oil. It now remains to be seen whether these will affect crude prices to any significant degree. Without some significant geopolitical disruption, such as the new instabilities in the Middle East and around the Straits of Hormuz, that would be perceived to be significant, we don't see crude prices now moving much higher than the current $85 a barrel, and any fresh demand weakness could just as easily drive prices down again. We have included a chart again that we've shown for a couple of months by the Energy Information Agency, which projects a general seasonal decline in motor fuel prices over the next 2 years. Now, with OPEC and Russia claiming to extend their voluntary production cuts through this quarter, this gives the EIA reason to adjust their view slightly upwards. Natural gas prices have generally declined significantly as production has clearly overtaken demand again, even with the U.S. exporting record amounts of liquefied natural gas in the past several months. Daily natural gas production is approaching 105 billion cubic feet per day, which is astounding from a historical context. The EIA expects Henry Hub prices to remain near $3 per 1,000 cubic feet, or less for all of 2024 and 2025. Total winter heating bills for gas users have ended significantly lower than last year. Underground storage reserves were already at the high end of their 5-year average range, so prices should remain moderate throughout the summer, which is again anticipated to be warmer than average. The winter storms which swept across the country caused brief temporary spikes in regional prices, just as we suggested would happen. However, in the past 2 months, Henry Hub prices have dropped by about 25%, so it continues to be a good time to look at locking in a lower price for home heating gas if you have that kind of option. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.